Welcome and good afternoon. I'm Amy Ellsbury, Senior Director of External Affairs at the Urban Institute. I want to thank you for joining us for this briefing on the data Urban has been collecting on housing markets throughout the pandemic. Our speakers from Urban's Housing Finance Policy team will walk through some of the questions policymakers have about the housing market in this unique moment. They'll also focus on ways you can interpret and track the monthly data yourselves. Before we begin, a few housekeeping notes. This event is being recorded. The recording and related links will be posted online after the event. You can adjust the settings for the captions or hide them with the live transcript button at the bottom of your screen. All participants are muted, but you can type your questions or comments into the Q&A box at any time. We will get to as many as we can, but even if we can't answer them during this session, we will follow up afterwards. It's very helpful for us to hear what you're thinking about to shape the work we do in the future. And if you will be tweeting, please use the hashtag #LiveAtUrban. At Urban, we strongly believe that facts, data, and evidence matter. Urban's a nonprofit research organization which does not take positions on legislation, but our independent experts make policy recommendations based on research and evidence. Their research helps frame and provide meaning to complex economic and social issues. Our researchers dig into nearly every topic in social and economic policy, and this year they're particularly focused on racial equity and the effects of the COVID-19 pandemic. The discussion today will focus on trends in the housing market, the inequities the pandemic may reinforce, and what data can tell us about policy solutions on the table. Understanding this data is critical for policymaking. As our speakers will describe, following trends and data can provide insight on how policies impact the housing market. The data also give us insight into which problems will be most pressing in the coming months. We really hope that this briefing will inform your work. Please don't hesitate to be in touch with us after the discussion if you'd like to dig in further, or if you'd like to learn about our data and insights on many other challenges the country is facing. You can reach us at externalaffairs@urban.org, and we'll post that email in the chat. And now I'd like to introduce our speakers, Caitlin Young, John Walsh, and Daniel Pang. Kate and Daniel are research assistants at Urban, and John is a research analyst. All three produce multiple reports on housing finance each month, including our monthly chart book. This compilation contains over 60 charts, all of which present indicators of how the housing market is doing over time. Today, Kate, John, and Daniel will walk us through just some of the key charts and show us how they inform 4 top-of-mind questions that policymakers have. First, Kate will walk us through data on how the housing market overall has changed during the pandemic, a question we get frequently from congressional offices. Daniel will then go a bit deeper and focus on homeownership trends and how homeownership has changed during the pandemic recession. He will also guide us through the data on racial homeownership gaps over the last several decades. This data may inform your work on racial equity policy. And John will share 2 charts that help us understand how government-backed mortgages trend in the market, and will explain what we can take away from these indicators. Please do submit questions to the Q&A box as we go along and we're digging into the data. We hope to make this information as relevant to your work as possible. And now, Kate, over to you.
Thank you, Amy, and thanks everyone for joining us today. So we'll be going over data from our monthly chart book, which includes a ton of information that we compile from various sources on the state of the housing market. So a lot of this data is publicly available in one way or another, which means that our role is primarily to present it in an easily digestible format, add context, and compile it in one place for industry leaders, policymakers, and practitioners to use as a reference guide. We hope that if you have questions about what's going on in the housing market, our chart book will be one of the first places that you check to gain a detailed understanding of the different forces that are at play. So obviously, a major question that is on many people's minds is what impact the pandemic has had on the housing market. Within our chart book, we have many data points that can help you interpret the effect that this recession has had. To begin, one of the key metrics that we have for measuring people's ability to pay their mortgages, as well as just their economic well-being generally, are serious delinquency rates. Serious delinquency refers to households that are behind by 90 days that's 3 months behind or more on their mortgage payments, as well as households that are in foreclosure. This includes people who have taken advantage of forbearance. So even though they're not making payments, if they're in forbearance due to COVID-19, they are still in good standing. The massive unemployment brought about by the pandemic led to huge spikes in serious delinquencies once households became unable to make their payments. For policymakers, this chart in particular is important, especially when thinking about protections that would allow people to remain in their homes, even when they can't make the payments for now. So for example, since the CARES Act enacted a moratorium on foreclosures, as well as federal forbearance protection, foreclosure rates have not risen, despite the fact that many people are unable to make payments. Mortgage rates are another huge factor to consider when thinking about housing market issues. While mortgage rates have recently risen very slightly, they mostly continue to drop since the onset of the pandemic. This is important to consider because it encourages strong demand for housing. People with the means to do so are encouraged to buy new homes because their housing costs will be affordable when paying a lower rate. However, the strongest impact of a lower rate environment is that people are really incentivized to refinance their existing mortgages. The effect of these low rates was that even despite the massive economic downturn over the past year, 2020 was a record year for new mortgages, or what we call mortgage originations. While 2020 was a very strong year for purchase originations, overall, around 2/3 of all new mortgages were in the form of refinances. So this means that existing homeowners were mostly the ones who benefited from these low rates by lowering their monthly payments and, as home prices heated up, building their overall wealth. Meanwhile, renters were much more likely to struggle during the crisis. This is still beneficial for those who were able to refinance because they could save on housing payments and build their overall wealth through home ownership. However, as Daniel will discuss in more detail, this had the potential to exacerbate existing wealth disparities, both between homeowners who could refinance versus those who could not, as well as between homeowners and renters. And now I will pass it over to Daniel.
Kate. I'm going to take us through a few charts on the current state of homeownership and affordability, and then also explore some of the data we have on the racial wealth and homeownership gaps we're seeing today. This figure shows the level of available housing supply in terms of months. The months of supply is the time it would take for all the current inventory to sell at the current rate of home sales without any new inventory coming into the market. For example, if the months of supply is at 3, that means it would take about 3 months until all the housing supply ran out if no new homes were being built. If you look at the graph from its peak in mid-2010 to today, you'll see that housing supply has contracted dramatically since the recovery from the Great Recession and is currently close to record low levels. During the lead up to the Great Recession, high demand for housing caused home builders to ramp up construction, which eventually left a large supply of vacant homes on the market following the foreclosure crisis. Since then, home builders have been more hesitant to construct at such rapid rates, which has contributed to the current supply shortage. As of last March, we had only 2.1 months of supply available, as demand is still strong in the current environment of record low mortgage rates, which Kate talked about a little earlier. This record low supply shortage has contributed to a strong increase in home prices and creates large affordability problems, especially for first-time and lower income homebuyers, which we'll see in the next slide. This graph shows year-over-year home price growth for 3 different home prices, bottom shown in gold, middle shown in blue, and top shown in black. As you can see, homes in all 3 price tiers are currently reaching their highest growth levels since the growth peaks in 2005 and 2006, leading up to the financial crisis. Although the appreciation rates move in similar directions across price tiers, low-tier homes have experienced a noticeably larger price growth rate than high-tier homes. Over the last 2 decades, low-tier home prices increased 126%, but high-tier home prices increased only 86%. This creates a huge affordability constraint, especially for lower-income households looking to buy more modestly priced or entry-level homes. Many households at the lower end of the market won't even be able to take advantage of the low interest rates to help offset these price increases. Although home price growth is currently reaching its highest level since the lead up to the financial crisis, it's important to note that the situation we're currently in is different than it was in 2008. It's a lot harder right now to get mortgage credit compared to 2008, which is what spurred a lot of the price growth at the time. Less risk is not always a good thing, since the marginal home buyer will end up getting locked out. We'll explore this more in the next slide. This graph shows the latest update of our Housing Credit Availability Index, or HCAI. The HCAI indicates how easy it is to receive mortgage credit. Lower Hakai indicates that lenders are imposing tighter lending standards, while a higher Hakai indicates that lenders are making it easier to get a loan. By our measures, it's much harder to get a loan today than it was before the Great Recession. If you take a look at the years from 2001 to 2003, highlighted in yellow, titled Reasonable Lending Standards, this was a period when we believed the right balance of lending was more or less in place. Our newest housing credit availability index for the fourth quarter of 2020 shows that mortgage credit was overall tightening in the second half of 2020 at just above a 5% chance of default in the fourth quarter of 2020, very close to the lowest point since the introduction of the index. We believe the tightening was driven by a reduction in risk across all mortgage channels, with many lenders choosing to lend to borrowers with higher quality credit than in the first half of 2020. Next, we'll take a look at some of the recent data on the racial wealth gaps and racial homeownership gaps, and also discuss how these two disparities intersect with each other. This data from the Federal Reserve's 2019 Survey of Consumer Finances shows that median wealth for white households in the US is around 8 times that of wealth for Black households and 5 times that of wealth for Hispanic households. We believe that one of the most important ways to bridge this racial wealth gap between white and non-white households is through increasing opportunities for homeownership. Homeownership is a crucial wealth building tool for all households, and even more so for households of color. As of 2019, home equity makes up 59.1% of net worth for Black homeowners and 57.6% of net worth for Hispanic homeowners, compared to only 43.3% for white homeowners. Even though home equity is such a significant contributor to wealth for households of color, we can see in this chart that homeownership rates have been historically low for households of color, especially Black households. If you take a look at the rates in 2020, you'll see that the Black-white homeownership gap at 30 points is as large as it was in the 1960s, prior to the passage of the Fair Housing Act in 1968. If actions are not taken to address this continuing issue, we project that the Black homeownership rate will continue to fall by another 1.3 percentage points by 2040 to 40.6%, a homeownership rate that is again lower than it was in 1968. I'll turn it over to JP now. He's going to take us a little bit deeper into the role of the federal government in the mortgage market, including the Federal Reserve's role in helping keep mortgage rates down at record low levels throughout the pandemic through its purchasing activity.
Thanks so much, Daniel. Before I proceed with my part, I'd just like to remind people, if you have any questions on the content you're seeing, you can drop them into the chat, and we'll have time for answering those at the end. Daniel's portion highlighted well how data in our chart book can show existing disparities, but data also can offer insights into the policy tools and interventions that are available to influence the market. This section, we'll get into that and see how what the government's role is in the mortgage market. This first graph shows the share of mortgage originations by year that were backed by the government. Meaning that the mortgage was purchased by one of 3 agencies, Freddie Mac or Fannie Mae, i.e. the government-sponsored enterprises, or Ginnie Mae, which is host to the Federal Housing Administration, Veteran Affairs, and rural housing mortgage programs. The gray bars, and those are represented by the blue bar. The gray bars here are mortgages purchased or backed by private mortgage originators, which are those that are either held by banks on portfolio or put into private labeled securities. When we look at the share of government-backed mortgages over the last 2 decades, we see a changing composition in the market. During the 2005-2006 buildup to the housing bubble, privately backed mortgages accounted for around 65% of mortgage originations. We flash forward to the past 2 years, we see that private share decrease quite significantly to around 22%, as that blue bar representing the government share increases. So what are the takeaways from this? Well, I think there are a few significant takeaways here. First is that the ultimate backer of a mortgage also has a large say in determining risk tolerance, meaning that as the government has taken on more of mortgage originations, they also have more power over determining, how much risk or, what type of consumer can easily access mortgage credit. I think the second key takeaway here is that the government takes on risk when they back mortgages here. But as we saw in Daniel's slide representing our Hakai, that risk in the mortgage market is generally, much less than what we saw in 2008. This next slide shows another way that the government is involved in housing finance, which is through the Federal Reserve's purchases of mortgage-backed securities. So purchasing mortgage-backed securities is one of the Federal Reserve's tools for influencing the economy. They increase purchases in times of economic uncertainty to stimulate the economy by bringing down interest rates. which when we think back to Kate's slides on mortgage interest rates during the recession, we see clearly that they have come down. We can see that the Fed first implemented this strategy in 2009, 2010 during the Great Recession, at the peak of which they bought $124 billion of MBS in March of 2009. And they have since revitalized this strategy during the onset of the COVID-19 pandemic, buying almost $300 billion worth of MBS in April of last year. Both through the purchases of mortgage backs, both through the backing of mortgages and the purchasing of mortgage-backed securities, the government influences the flow of mortgage debt through the financial system. This in turn raises policy questions about the appropriate level of risk we should be taking. It has implications for consumer access to mortgage credit, and it also largely determines levels of liquidity in the market. And with that, I will turn it back to Amy.
Thank you, John. Thanks so much to Kate, Daniel, and John. Before we move to some Q&A, I want to highlight all the ways that you can stay connected to this research that Urban is doing on housing finance. Our website, Twitter, and newsletter information are shown here, and you can always contact us, as we said, at externalaffairs@urban.org. So go ahead and put your questions into the Q&A box, and we're glad to share them with the speakers. But I'm going to get us started. John, you all have shared 10 charts, but I know the monthly chart book includes over 60 charts. What are some of the other indicators that you all are tracking that we didn't get a chance to dig into deeply today?
Yes, 60 is a lot of charts, and there's a lot in there. There's a lot of angles to look at the housing market. I'll highlight a few that I don't think we touched on here. First is that we track the overall size of the mortgage market. So we look at outstanding debt versus equity over time. We look at the composition of that debt by product type, whether it was mortgage debt used to purchase or refinance a home versus mortgage debt used as credit. We also look at the composition of who was originating those loans, going back to, was it government, was it private? The chart book also closely follows monthly changes in the characteristics of mortgage origination. So this is the percent of new mortgages that were refinances as well as cash out refinances. We also look at who is originating the loan, as in, was it a bank that consumer got their mortgage through? Was it a non-bank? And we track very closely the quality of new credit. So we look at changes in average debt to income ratios, loan to value ratios, and FICO scores over time. I'll also highlight, we provide indicators on how existing mortgages are performing. So we show the share that are seriously delinquent, they're behind 90 days or more on their mortgage payment. We show the share of homes that are in negative equity, meaning the debt outweighs the equity in their home. And more recently, during the COVID crisis, we've added an indicator tracking the number of loans that are in forbearance by channel, which has been a very important indicator for how homeowners are performing during the crisis.
And just one quick follow-up on that. What kind of geographic breakdown do you have? Are these all national numbers, or can you split them up by state or even congressional district?
Yeah, so the strong majority of the data in the chart book is national booking, but we do have some state breakouts. So we look at, we have state and we have metropolitan areas. Unfortunately, we don't get as granular as congressional districts, as much as we would love that. I think that, the data can only tell so much, but we tell the story of how different metro areas have recovered in terms of home prices since the recession. We look at the state level at indicators of affordability by state. So, if there's one thing that is so important to stress in housing data, it's that affordability changes drastically by which market you're buying in. In certain cities or states, i.e. California, it's much harder to buy a loan. You have to have a much larger down payment just due to home prices. And so we kind of look at those variants across states.
Thank you. We have a question in from the group. What needs to be done to encourage more building of lower price homes for first-time home buyers?
Yeah, I can offer the first thought on that, and then maybe pass it over to Kate or Daniel if they have anything to add. I think one thing we do research, and I don't think this is as much in the chart book, but one thing that Urban has done a lot of research on is how certain areas have put restrictions on the ease of building affordable housing. So whether that's through restrictive zoning, making it only able to build single family homes as opposed to 2 to 4 unit homes, which tend to be more affordable. Whether that's through the ease of financing those types of things. This is something we also look at it. There's not as many programs for getting financing for the kind of more dense, 2 to 4 unit or even multifamily units as there are for the single family housing options. So I think, making those are two things that right off the bat you could do to make it easier to build the kind of affordable housing. Daniel or Kate, if you have anything to add on top of that.
Yeah, I would just add to that, JP, some of the types of affordable housing that we explored within HFPC and at Urban more generally include things like ADUs, manufactured housing, prefab homes, and a lot of that in terms of the zoning regulations that go with that. That's, as JP mentioned, a huge part as to why these aren't constructed in sort of the more traditional site-built home neighborhoods that you typically be seeing. And then on the financing side, as JP mentioned, there's definitely room to expand access to things like small dollar mortgages. Looking at models like shared equity models is also another way I feel that we explored a little bit deeper on our end and on the policy perspective.
Thank you. We have another question, which is, has Urban thought about how appraisal waivers during COVID, which appear to be concentrated among 80% AMI and lower, might affect risk down the road? Something you guys have been looking at?
So, I mean, it's a good question, and we certainly are. Appraisals have been a large area of interest for us. I don't think we've looked at it in terms of risk as much as we recently have looked at kind of the racial bias that you can see in appraisals. That our colleagues recently put out a paper looking at automated valuation models and how those might be biased for households of color. I'll toss it over. I don't know, Kate or Daniel, if you have anything to add on that.
Nothing more. Daniel, I have another question for you. The rise in home prices we've seen over the past year is reminiscent of the buildup to the 2008 bubble. Is there any reason to be concerned about that? What is our chart book saying about kind of comparing that time frame and this time frame?
Yeah, that's a great question. So let me actually take us back a little bit further into one of the charts that we saw. Sorry, this is lagging a little bit. So I want to take a look at the Hakai again and sort of take a look how I mentioned before, how during the lead up to the crisis, lending in terms of product risk and borrower risk, lending access to mortgage credit was a lot easier to get during these years compared to what it is today. And so a lot of the home price buildup that we're seeing today, and kind of shown in this graph here, has a lot to do, as I mentioned, with the shortage of housing supply. So you'll see during the years during the financial crisis and also the years leading up to it that housing supply was a lot higher than it was today. And so in terms of the housing prices back then compared to where they are today, I'd say they're a lot more of the rise in prices today is more influenced by the supply shortage in combination with access to credit more so than it is to more so than it is when it was really like leading up to the recession, to where prices were more influenced by the underwriting process and access to loans.
We have another question in the chat, which is, how can we limit racial bias in the housing market when there's a growing use of technology like AI in this market? Has the team been looking at those questions?
Yeah, that's a great question. I think I mentioned this paper on the valuation question, but we recently looked at, there's a blog we put out called "Why Automated Home Valuation Technology Errors Disproportionately Affect Majority Black Neighborhoods." That gets into this well, where we found that when we use AVM models, it tends to devalue homes in majority Black communities disproportionately. But I will say, there's so much literature on racial bias and AI. One thing we also know in the housing market is that, There is also racial bias when we don't use AI. When you have, I think Brookings has done research on this. When you have appraisers going into homes with some indicator that this is a Black household, they tend to appraise it lower than when you take away those same indicators. I think while AI there are seriously things to worry about in terms of making sure that we don't let racial or racism and racial inequity influence how AI functions. It also offers a lot of solutions, I think, to, if done right, to kind of weed out the existing racial inequity that exists in the housing.
Thank you very much. We are getting close to the end of time. So I want to thank you all, Kate, John, and Daniel, for this deep dive into the data on what's happening in the housing markets. And our discussion today really reinforces for me the important back and forth that needs to happen between policymakers and researchers. So we are so appreciative that all of you joined us for the discussion today. And please follow up with us if you have any questions. We dropped a lot of links there into the chat, but we're also happy to we'll provide many of them in our follow-up email with you. So thank you and take care.